Hey everyone, welcome back to the channel. So in today's video, we're going to talk about the possibility for a recession this year in 2022. And essentially the goal of this video is going to be to lay out 5 potential headwinds that the economy and that the stock market might be facing this year. Now, I don't want this to come off as something where we're saying that there's an absolute chance of a recession this year. This is simply just some different ideas and concepts that I thought would be very useful to lay out here in this video, because the truth is that nobody truly knows where the stock market's going to be 12 months from now, and nobody truly knows where the economy is going to be specifically a year from now or 2 years from now. And if they're making a video and saying that this is exactly where the S&P 500 and the Dow is going to be 3 or 4 or 5 months from now, they're probably just pulling it out of their ass because they don't really know. So nobody truly knows. The smartest people in the world don't know. We can make predictions, we can make guesses, and we can kind of look at some economic data, which we will in this video, and try to come to some type of a conclusion on where we believe the general direction of the economy might be going. So let's go ahead and get started with this video. Now, one thing that we need to make clear here is that the stock market is not necessarily the economy. These are two different things. We're going to talk about both, about the stock market and the economy and potential headwinds for both. But the stock market tends to be more forward-looking, whereas the economy, when we look at economic data, it's usually from like last month or last quarter or even last year. So the economic data, it's kind of like looking in the past, and the stock market is looking in the future. And that's why we're seeing a lot of stocks selling off over the past couple of months here. Really, since December, we've seen some really large drawdowns in some specific stocks and an insane amount of volatility. Like Snapchat, Snap stock was up like 50% in a day. Facebook was down 26% in a day. They lost hundreds of billions of dollars in a day. Amazon shot up 15% in a day. It was one of the largest value gains from a company in a day. So we're seeing a lot of volatility right now. Obviously, there's a lot of people are getting a little worried. So let's talk about those headwinds. And this video is brought to you by Moomoo, so you can get 5 free stocks. Link in the description below. If you want to get 5 free stocks, it's kind of a no-brainer. Makes sense, right? Okay, so first of all, I'm going to say this, that I think most speculative assets, they're dead. I mean, I think the dog coins, the meme stocks, and I know I'm going to trigger some people here, but I really think that they're dead, and I don't think that they're coming back in a high inflation environment. So you have to understand that if you're going to get anything out of this video, it's that speculation almost always dies off when there are high levels of inflation. We're at the highest levels of inflation that we've seen in the last 40 years. So when we have high inflation, speculation dies off. And it was pretty easy to see that we were in a very large bubble in 2021 when we had these absolutely crazy things going on, like the meme stock mania in the spring, and we had like crypto shooting up 10,000%. We had so many things going on. There was insane levels of speculation, and a lot of that has been selling off. So be careful in like catching a falling knife. If something's down 80%, don't just buy it because it's down 80% and you think it's going to pop back up and, like absolutely blow up. It's possible, but make sure that you have something like more than that if you go into that investment. Of course, I'm not a financial advisor. I'm just a random guy on the internet, so don't take too much advice from me here. Okay, so let's talk about these headwinds. There's 5 or 6 different headwinds that we might be facing. The first one for the economy and definitely for the stock market is inflation. It's one of the top words used this year, I think. The word inflation, everybody has it in their vocabulary right now. But let's talk about how this can affect the stock market. All right, so the biggest problem right now for a lot of stocks, and the reason why a lot of them have been selling off, is because if you have companies that are like, they're basically high PE companies, they have a lot of growth expected or earnings expected like 5 or 10 years down the road, a lot of those companies, their stocks have been selling off since December. And this is because there are fears of more rate hikes and more inflation. And so what happens here, and the reason why these high PE companies sell off, basically like the more speculative the company or the further out their earnings are, the more they've been selling off. And the reason for this is because if you have high levels of inflation, you're going to have to devalue the sales and the revenue from a company that might be projected like 10 years from now. So you can use something like the price earnings to growth ratio. It's a great one to understand. Just do a quick Google search on what the price earnings to growth ratio is. But compare that to a company like, say, like oil companies. And I'm not saying that you should invest into oil companies, but there's a reason why they've been absolutely pumping for the past 2 months. And it's because they are pulling in so much cash right now. And so companies that are pulling in a lot of cash right now are doing okay. And a lot of them have not sold off. In fact, they're actually up on the year versus the companies that have earnings like 5 years down the road where they're projected to make a lot of money, or 10 years down the road, you have to devalue those. You have to discount the dollar, because a dollar today is worth so much more than what a dollar might be worth 5 or 10 years from now, especially with historically high inflation rates like what we have right now. So that's the biggest concern for inflation. This could of course flip, and suddenly, we could have inflation calm down and, it goes back to 3%, and all these companies that are down big time, like the ones that are really speculative, like say even like Robinhood or Zoom or Peloton, a lot of these ones that have sold off like 70 or 80%, they could possibly pop if inflation chills out and it relaxes, if you think that's going to happen. I personally don't think it's really going to happen unless the Fed starts jacking up rates way more than 4 or 5 basis points this year, but that's a whole nother discussion. So that's one of the first concerns that people have, is obviously going to be inflation. Now, since World War II, there has only been one time where inflation was higher than 5% and we didn't have a recession that followed. So I'm going to say that again. There was only one time in history since World War II that we had 5% or higher inflation, and a recession did not occur immediately after that. And that time was I think it was 1951. It was during the Korean War. But pretty much every other time when we have spiking inflation, it's followed by a recession. So that's just one indicator that you might want to look at. There's a couple of reasons for this. One of the big ones is something like when the Fed has to start raising rates to try to curb inflation, this can almost throw us into a recession. Now, I don't know if that's going to happen because we have other problems today, like we have $30 trillion in debt, and if we start raising interest rates, we're going to start defaulting on debt like the entire country. So that's a whole nother can of worms that I don't even think we want to go into today. But look at something like the early 80s, when the Fed basically had to cause a recession in order to curb inflation, because inflation was running double digits, 12, 13, 14%. And so the Fed had to crank up, they absolutely dialed up interest rates to try to stop inflation. And it actually did work for the most part. Now, I don't know if that's going to happen today because like I said, there's going to be a lot more problems with that. But it's something that you want to think about. That's why the markets have been selling off a lot. And it could honestly throw us into a recession. So if the Fed starts to dial up rates too quickly, or if they move too slow, those are both problems. And right now, I feel like Jerome Powell doesn't really know what's going on. I certainly don't either. I'm not saying that I would have some type of better idea than him, but you can kind of tell from, whenever you hear him talk, I just feel like the Fed doesn't really know what they're doing right now. And they've kind of made that clear. Like they really are hoping for the best, that inflation subsides and that supply chain catches up and everything balances out. But they're really helpful right now. And it's also midterm. I'm not going to go into politics, but yeah. Okay. By the way, if you want to get 8% yield on your cash, you can use something like Gemini Earn. I'll leave a link to them down below. I got to pay my bills. It's an affiliate link, but 8% yield, I think it's pretty great. I do this with my excess cash, and it keeps up with inflation. So you can go ahead, check out that link down below. You also get like $25 in free Bitcoin if you put in $100. So shameless little plug right there if you want to check it out. So the other potential headwind for the economy and for the stock market is actually still supply chain issues. So a lot of people are saying that supply chain, it's going to be fixed this year, and that it's going to get better, and that eventually supply chain is going to catch up. Obviously with COVID, and especially with China having like the zero COVID policy, it has definitely put a strain on supply chain. It's the reason why global shipping costs have gone up like 4 or 5-fold. So if you look at the cost for a shipping container, to get a shipping container from one part of the world to another, that has gone up about 400 or 500% over the past year. Now, a lot of that is because of, like I said, China and their zero COVID policies and other supply chain disruptions. But I'll also say this, that supply chain, I really don't think it's just going to fix itself on its own, just from, like people getting out of COVID. Because right now we have more stuff flowing in through the ports in the United States than ever before in history. A big contributor to why we have inflation right now is because of just people buying so much more stuff. We had like billions of dollars in stimulus money flowing in. So people are buying more stuff. There's so much consumerism right now in the country that I think the only way that supply chain is going to subside and become much more in like this equilibrium is actually if people start feeling the effects of inflation, and so they curb their spending habits a little bit, they slow down on spending, and then actually that could cause inflation to sort of like come down a little bit. Now the other problem, I kind of love arguing with myself, if you didn't notice here. But the other problem is if we enter into this thing called like a wage price spiral, where basically what's happening now is because we have rising costs for shipping and production, and people are paying more, like just look at the price of used cars, it's up like over 30% in the past 12 months. Because we have all of that, what's happening now is that a lot of companies, they're starting to raise prices because they have to make money. And when they raise prices, then all of a sudden, all the employees need to start getting paid more, and then all those employees get paid more, and then they can afford more, so they can pay higher prices for those things, which then means that then that company then has to raise prices again, and then those employees get paid more, and so it creates this spiral of wage price spiral, which is not good. Now, once again, I don't know if that's going to happen. It is a possibility. I don't want to sit here and like act like there's going to be some type of massive like hyperinflation this year. I don't think that's going to be the case, but I do think there's going to be this blip in time here for the next 2 years that we're going to have quite a bit of inflation. And I'm really hoping that it doesn't come to a spiral, really, because that would be bad. All right, so I want to give you 3 more potential headwinds or problems that we might see in the economy and in the stock market. And so one of them, it's actually pretty simple. It's not like extremely complex whatsoever. And it's basically just that there's not as much potentially to look forward to this year in terms of economic growth as compared to the previous 2 years. So just in the most basic example here, in the past 2 years, especially retrospectively looking back on this, it's pretty easy to see why the economy was growing and why the stock market was growing. Not only did we have trillions of dollars pumped into the system, but also we were clawing out of this massive pandemic. And so clawing out of a pandemic, climbing out of it, obviously, you're going to have economic growth. So it makes sense why the economy and that the stock market has been growing for the past 24 months. But now that we've basically like dug out of this hole and we're looking around, there's almost something to be said about what's next. What's going to be the next thing that the economy can really find some growth from, and then we can see, returns in the stock market of like 10, 15, 20%. So what's going to spur that? And that's a big question that a lot of people have. So it's just one small thought there. I'm sure this thought has been coming, many other times in history of basically just what's next. We're out of this pandemic hole, and so it might be a little bit harder to maintain those levels of growth that we've had in the past 2 years. Okay, so the other 2 reasons here, they kind of bundle in together here, and essentially another potential problem here is what we call taper tantrum. I mean, if you study the stock market in 2018, you'll know that basically the stock market had something called taper tantrum, where the Fed came in and they said, you know what, we have great unemployment numbers. We're in like some 3% here almost. And so we're going to start to raise interest rates. This is what the central bank decided to do. And immediately when they started doing that and they started weaning off of the bond buying program, suddenly the markets started to slide, and we saw this decline in 2018. It wasn't horrendous, but this was largely affected by something called taper tantrum, when the markets didn't like that we were weaning off of the Fed here. And so basically that leads me to the last point here, which is probably the biggest concern for the economy for this year and for the stock market, is essentially just, is the Fed too early or is the Fed too late in terms of their bond buying program and in terms of interest rates? So the Fed is basically like the largest manipulator in the world and in the markets, and in the economy. Like, the Fed's goal is to try to make sure that inflation and that unemployment are both at the proper numbers, right? They always want inflation to be around 2%. But if the Fed is too early to something like this, and the Fed starts to raise rates, they said they're going to raise them probably like 4 basis points, maybe 5, 6, potentially 7. There's some estimates on 7 basis points this year, which would be like 1.75%. So if they raise the rates too quickly, that could, in effect, throw us into a recession. It's happened before in the past. Or if they raise the rates too slowly, that could also be a problem, because they could end up causing a bigger bubble than what we're probably already in. So, for example, look at something like the housing market, say in like 2003, 2004, 05. The Fed, like, retrospectively looking back on it, they probably should have increased rates so that they could hopefully cool down the housing bubble. But they didn't. They acted too late. And so the question really is, I suppose, is that should we be having 0% interest in an economy that has unemployment below 4% and inflation that's running over 7%? That's the big question. Yeah, it's fun to think about. It's stressful, but it's fun also at the same time. So if you have any questions, feel free to leave them down below. Those are just some basic ideas of the economy, where it's going in the future. I want to reiterate, I don't think we're going to be spiraling into some type of like massive depression or massive period of inflation. I think it's going to be more problematic than what the Fed's still making it out to be in terms of inflation. But hopefully when supply chain does, like when the problems do subside in supply chain, hopefully we don't end up in some type of wage price spiral and we're able to get back to a good point for inflation. Now, I just want to end this with this. I do think inflation's not going to be a long-term problem because we have an aging population in the world. A lot of countries with aging populations and also things like technology, like if you listen to Kathy Wood a lot, which, you know, she's down 55% this year, so don't listen to her too much. But I think she is right on one thing, which is that with these technological advances, that could be driving down a lot of prices, and we can almost see like this deflation over a long period of time, thanks to a lot of technological advances that are bringing down prices. Like, for example, televisions, the price has been coming down for so long, and a lot of other things as well. Prices have been coming down, and that's a really good thing as well. Long term, I think it'll be okay. But transitory, Powell said we have to retire that word for some pretty obvious reasons, because even if we had inflation that was at 10% for 3 years, that compounds on itself. So your money's going to be worth probably, I don't know what the math is on that, 10% for 3 years is probably going to be coming out to like almost 40% less of the dollar value 3 years from now if we were at something like 10% for 3 years. I don't know if that's going to be the case, but yeah. Okay, so thanks for watching the video. Don't forget to check out some of the links down below to support the channel. You can get 5 free stocks on Moomoo. You get that 8% yield on Gemini Earn. I think they're both pretty great deals. So thanks for watching the video, and I'll see everybody in next week's video.